we're doing a deep dive explainer on Microsoft's 2026 financial landscape. I mean, we're literally peeling back the curtain on exactly how a legacy software giant transformed itself into an absolute AI hegemon, knocking on the door of a staggering $4 trillion market cap. And hey, as investors, we're not here for the hype, right? We're here for the data. Our goal today is strictly objective and entirely numbers-driven. We're going to look under the hood at the exact revenue segments, the intense capital expenditures, the strategic margin fixes, and the detailed financial forecasts driving this titan. If you want to understand the architecture of modern tech valuation, you are absolutely in the right place.
All right, here's our roadmap for today's explainer. Number 1, business model and moat. 2, the Q3 2026 earnings breakdown. 3, valuation covering PE and PEG ratios. 4, major problems and fixes. And 5, growth and 2070 forecasts. Let's get right into it.
Part 1, business model and moat. Let's look at exactly how they make their money.
Okay, so Microsoft's highly profitable business model is perfectly diversified across 3 massive financial pillars. First up, productivity and business processes. Think Microsoft 365, LinkedIn, and Dynamics. In 2026, the real growth engine here is Copilot upselling. The company is actively migrating standard enterprise users up to their premium AI tiers, which drastically expands their profit margins without significantly bumping up customer acquisition costs. Second is the intelligent cloud, which is basically anchored entirely by Azure. Azure has really evolved into the default infrastructure for the generative AI economy. Every major startup and Fortune 500 company relies on it for their compute power. Finally, we've got more personal computing, housing Windows, Xbox, and Search. Now, while the traditional PC hardware market has definitely softened up a bit, the complete integration of Activision Blizzard has effectively transformed their gaming division into a super reliable, massive recurring revenue contributor.
Now, the absolutely crucial concept to grasp here is Microsoft's true competitive advantage, what leading analysts are now calling the moat of the moat. Basically, Microsoft is the first commercial entity in history to establish impossibly high switching costs across 3 simultaneous technological layers. You see, they control the infrastructure layer with Azure, the workflow layer with Microsoft 365, and the developer layer with GitHub. Each of these layers on its own is the size of a formidable mid-cap tech company. But when you lock all 3 together, it creates a wide economic moat that competitors just cannot breach. If a rival like Google or Amazon attacks one single layer, the other 2 remain perfectly intact, completely shielding the company's core cash flows.
Part 2, Q3 2026 earnings breakdown. Let's see how that moat translates to real-world performance. Honestly, the numbers here are just jaw-dropping. Microsoft delivered a record-breaking quarter with total revenue hitting $82.9 billion. To put that in perspective, that's an 18% year-over-year increase. For a mega-cap company of this sheer size, sustaining 18% growth is practically unheard of in traditional markets. And the driving force behind this massive number? The Microsoft Cloud. Cloud revenue alone accounted for over $54 billion of that total. And this wasn't just organic growth either. This was fueled by intense, capacity-constrained demand. Enterprise customers are basically begging for AI infrastructure and GPU access, which means Microsoft is selling compute capacity just as fast as they can physically plug the servers into the wall. The profitability profile? Equally staggering. Earnings per share came in at $4.27, comfortably crushing analyst estimates of $4.06. But here's what makes this EPS beat so wild. It's the free cash flow dynamic happening behind the scenes. See, Microsoft is currently pouring tens of billions of dollars into building AI data centers and buying custom hardware. Normally, that kind of astronomical spending crushes a company's bottom line. But Microsoft's legacy software business is such a reliable cash-printing machine that it fully subsidizes these unprecedented capital expenditures. That's exactly what's allowing their adjusted net income to just keep soaring. When you break that revenue down by segment, the hypergrowth narrative becomes crystal clear. Intelligent Cloud pulled in $34.7 billion. That represents an explosive 28% growth in constant currency, entirely carried by Azure's dominance. Productivity also showed incredible fundamental strength at $35 billion, up 13%, heavily driven by commercial cloud renewals and really aggressive Copilot seat adoption. However, take a look at the more personal computing segment. It pulled in $13.2 billion, but actually saw a decline of 3%. That slight drag reflects a continuing softness in the consumer PC hardware market, plus a particularly tough year-over-year comparison in their gaming division following last year's massive acquisition boosts.
Part 3, valuation, PE, and PEG. Let's price the hegemon.
So with those phenomenal earnings, we've got to ask the big investor question. Is Microsoft stock currently undervalued or overvalued?
Well, let's look at the forward PE ratio. Microsoft is currently trading between 22.9 and 24.8 times forward earnings. When we compare this against a broad industry peer average, which includes giants like Apple and Google, sitting at roughly 21 times, Microsoft is clearly trading at a premium. But is it overvalued? Analysts vehemently argue no. The justification for this higher multiple is Microsoft's superior earnings growth trajectory. They're delivering a 20% compound annual growth rate compared to the peer average of just 16%. Because their AI monetization is accelerating faster than anyone else in the sector, investors are more than willing to pay that premium upfront. But to truly grasp the valuation, you have to look at the PEG ratio, price/earnings to growth. Microsoft's PEG is currently sitting at a surprisingly low 1.51. To put this in context, a PEG ratio measures how much you're actually paying for every unit of growth. An average tech industry PEG for AI-exposed equities often hovers around 2.0 or even higher. So when you compare Microsoft's 1.51 against that standard, it reveals a massive disconnect in the market. It implies that relative to its massive 27% year-over-year earnings growth expectations, the stock is historically cheap. Ultimately, through both the forward PE and PEG lenses, the fundamental data suggests the stock is moderately undervalued with significant upside potential.
Part 4, Major Problems and Fixes. Now, it hasn't been a totally smooth ride. In 2025 and 2026, management faced some massive, almost existential roadblocks. First off, they burned through a staggering $31.9 billion in capital expenditures in a single quarter. That level of cash burn severely tested investor patience and sparked some real panic about profit margin compression. Second, they faced intense global regulatory heat. Like, the Japan Fair Trade Commission actually raided their Tokyo offices in early 2026, piling onto ongoing EU and US FTC antitrust probes. And third, they had a really dangerous, costly reliance on NVIDIA GPUs. But, to their credit, management aggressively engineered strategic repairs. To combat the margin pressure, they're shifting from flat per-seat pricing to highly lucrative usage-based Copilot models. To address the global regulatory crackdowns, they're rolling out localized sovereign cloud regions. And to break that NVIDIA bottleneck, they deploy their own custom silicon. Let's dive a bit deeper into that silicon fix, because it is absolutely critical to the bottom line. The custom Maia 200 chip is basically Microsoft's silver bullet for soaring AI compute costs. Built on TSMC's cutting-edge 3nm process, it delivers massive performance. But the most important metric you need to know is that it delivers 30% better tokens per dollar. In simple terms, a token is the raw cost of generating a word or a piece of data using AI. By making that process 30% cheaper than the latest NVIDIA silicon in their fleet, Microsoft fundamentally saves its margins. And the ultimate market validation of this tech? AI powerhouse Anthropic is reportedly in talks to become the first external customer to rent Azure servers, specifically running Maia 200, which proves it's a true, viable competitor in the hardware space. Part 5, Growth and 2027 Forecasts. So how are they planning to grow over the next 3 years? Well, Microsoft has a meticulous 3-step strategy to evolve from a software giant into the undisputed bedrock of the generative AI economy. Step 1, shifting from simple chatbots to autonomous agents. We're talking about AI that can handle complex, multi-step business workflows, like entirely automating HR onboarding or supply chain auditing with zero human intervention. The total addressable market for replacing human workflows is just astronomical. Step 2, accelerating Copilot upselling across their massive installed base of over 400 million commercial seats, which locks in pure recurring revenue. Step 3, aggressively expanding sovereign AI. Nations around the world are demanding local data processing because of strict privacy laws and national security concerns. By building localized data centers globally, Microsoft ensures they capture lucrative government and highly regulated enterprise contracts that competitors literally cannot touch. So, what does this all mean for the stock price in 2027? Let's walk through the multiple scenario forecasts. In the bull case scenario, analysts are projecting a target price of roughly $840 per share. That represents a potential total return of well over 100% from recent baseline levels. For this to play out, agentic AI must become the undisputed enterprise standard, driving massive margin expansion as Copilot monetization scales limitlessly alongside sustained Azure dominance. It's a scenario where Microsoft essentially taxes the entire AI economy. Conversely, we have to look at the bear case scenario, where the target drops to around $563. Paint a vivid picture here. Imagine a severe macroeconomic recession that ruthlessly cuts corporate IT budgets. Combine that with massive multi-billion-dollar antitrust rulings in the EU that freeze their operations, and a scenario where their $30 billion quarterly AI capex bleeds cash because enterprise adoption stalls out. That intense margin compression is the very real downside risk investors must weigh against the unprecedented growth. And that brings us to our conclusion. As a quick reminder, the information presented in this explainer is for educational purposes only. You should always do your own thorough research before investing in any company. But as you digest all of this financial data, the incredible revenue scales, and the valuation metrics, I'll leave you with one final question to think about. Looking at Microsoft's absolute lock on the infrastructure, workflow, and developer layers, can any competitor on Earth truly challenge this unprecedented AI moat? Thank you so much for watching this explainer, and keep learning.